Morning, everybody. Almost June. It's Tuesday. I was about to say happy June, happy Tuesday, but it's not quite June tomorrow. But I hope you enjoyed your Memorial Day weekend. I hope you all remembered why we celebrate or take the time to acknowledge Memorial Day. Very important day, of course. But I hope you all enjoyed it. I had a nice 4-day weekend. So nice little break with my family. And we had a bit of a family reunion at my place, which I always love. I love cooking for everybody. So it's always fun for me. All right, jumping into it. So, I've considered, and I'll take your feedback on this. I've considered not having the Tuesday weekly webinars on days following the holiday because I really, there's not a lot of information. Most of the analyst information and the market wrap up for the week comes in on Monday, and it gives me an ability to compile it. But I put together information for you. Don't worry, we've got lots to talk about. But I've considered skipping those weeks, so I'll look forward to your feedback on that. But welcome to the 31st. Remember that you're all muted. That there should be a question and answer section, a Q&A button on the bottom of your screen. And I think that's it. So let's just do me a favor and let's check in. Just raise your hand, hit the raise hand button if you can hear me and see me okay. Great. Good seeing everybody. Thank you. All right. Okay, so there is no webinar, however, next week. So next Tuesday morning at 10, there will be no webinar. I don't think I'm going to have the time to record one throughout the week, but I don't miss many, a few a year, but that next week there will not be one. I have a family commitment. Today we're going to talk in our financial planning. Oh, I'm sorry. Let me go back. We do have a class starting next week again on the 9th of June, and you'll receive an invitation for that. Hopefully by Thursday. I like to send them out about a week ahead. So starting the 9th of June, and then again on the 14th of June, and there'll be 3 2-hour classes. So they'll be coming up. Today, we're going to talk in our financial planning. We're going to talk about what is an RIA, or registered investment advisor, and what is a registered investment advisor firm. So this is a recent change that we made with Attleboro Wealth Management, and there was a really good article about it over the weekend in Forbes. So I thought it was a timely discussion. We've been affiliated for many years with RIAs, whether it was LPL and Kestra, and before that NFP. But Attleboro Wealth Management is now a standalone RIA, and want to talk a little bit about what that means. Because again, I've had some questions, and the article is timely, so we'll talk about that. As far as headlines, the headline I was looking at today was, of course, inflation. We're all talking about inflation and what the concerns are. One of the research reports that I read from and what's now in power was Prudential. They were using that transitory term again from inflation. And folks, this is not a transitory type of inflation that we have. Hopefully, it's not significantly long-lived and it can be dealt with, but it's not just a short-term issue that we have. So in Market Watch, I like to reference things that you can look up yourself. The headline was U.S. stock futures. So what we're trading out today, which is, or what they showed that we'll be trading out today, which is true. We're down across the market so far. U.S. stock futures point lower after week's bounce, with Biden and Powell set to talk about inflation. So Chairman Powell was confirmed last week again to be the chair of the Federal Reserve. So the question is really, what kind of ammunition do they have other than raising rates? And they being the federal government, raising rates to bring down inflation. And there are, of course, the balance is how fast can you raise inflation raise interest rates to help ease inflation without completely stopping your economy. And there are other things involved. We still have supply chain issues. We all experience that. I was talking to a family member over the weekend, and they said they bought a new car, and they said there was just nothing on the lot. Where, we still see food supply issues, and I can't believe I picked up hot dogs for the party, and they're $7 a pack. Unbelievable. But we're all dealing with this, and unfortunately it hits the lower income and lower asset level households more than others. So that discussion continues. So our Ed Slott updates this week. So I'm going to first read you the mailbag, and then there's a little, there's a good article by Andy Ives that's a little confusing. So I'm going to have you read along as we do, but this is going to discuss RMDs. Actually, there's a lot of discussion about RMDs this week. This is an area that just is getting more and more confusing, unfortunately, and really dominates now the conversation of questions that are coming in to the Slott group from advisors and individuals. So let me share my screen here with you so you can see my notes and follow along on this important conversation about your IRA. Because even if you're not taking required minimum distributions now, if you're not of age, right, 72 at this point, to begin your required minimum distribution, you can have an inherited IRA. And at some point, hopefully you'll have to take these RMDs, right? If you are still with us, and maybe if either it works out for you where you can have funds in an IRA, or if you haven't quite finished your Roth conversions, because one of the goals, of course, is to move your funds to a Roth IRA so you don't have required minimum distributions. But that there often is a part that we can keep in an IRA where if it's below, if the RMD is below your standard deduction, remember, absent any other income, that you won't pay tax on that. So that's a good thing if we have a situation where we're taking money out of a traditional IRA and not paying tax. So here's the first mailbag set here by Sarah Brenner. You've all met Sarah. So the first question here is, I am 79 and I make SEP IRA withdrawals annually as required. So a SEP is a self-employed, simplified, employee pension. And it's for typically self-employed people. There are some significant requirements if you have employees. So many people with several employees don't use a SEP. It's usually for one or two people in a business. But in this case, he's 79, this person's 79 years old, and they make SEP IRA withdrawals annually as required. I also have several regular non-IRA accounts. One fund I own throws off a tremendous taxable gains, tremendous capital gains every year. Is there any way I can move into an IRA account with it without selling it first in a taxable transaction? So this is a really great illustration of some of the confusion that's out there about taxable accounts and IRAs and how they're interchangeable and how they're not interchangeable and how they work. Many people think that we often get the question, can I make my IRA jointly held with my spouse? Well, you can't do that. It's an individual retirement account and it can't be held jointly. Your spouse can, of course, be a beneficiary, but you can't hold accounts jointly, IRA accounts. And that's true of SEP IRAs. It's true, of course, with your 401k. So it's important. Most of you folks have gotten really good at identifying those buckets: taxable, tax deferred, and tax-free. Just remember that the ones on the right, the tax deferred and tax-free, can't be held jointly. They're treated differently. And you've heard me say that even your 401ks, your retirement plans, your 403bs, your SEP IRAs, your simple IRAs, and your traditional IRAs, they all have different rules. There's nothing that Congress does when they put together the rules and the IRS then figures out what the intention of Congress was in the legislation. So when they put together these rules, they don't think about making it easy for us, I don't believe. So the rules are very, very complicated and they're different for every type of account. So here's the answer. You can see, I'll just stay here so it doesn't confuse you with the next question. I'm right here. There are several roadblocks to moving your non-IRA to an IRA. The only way that funds can go to an IRA is if they're being rolled over from another IRA or from a qualified employer plan, like a 401k, or if they are an IRA contribution. The account you are describing is not an IRA or a plan, so a rollover is off the table. So you can't take several $100,000 or $1 million in your taxable account and roll it into an IRA. There's nothing that allows you to do that. Only contributions. So if you're still working, you can contribute $7,000 a year if you're over 50, so you can kind of winnow away at it, but there's not a significant amount that you can put into traditional IRA, this person's trying to take money that's creating a taxable capital gain every year and put it into something that's either tax deferred or tax free. Good thought, but IRAs isn't the way to do it. The account you're describing, okay, so IRA contributions must be based on earned income and must be made in cash. Therefore, even if you have earned income, you would not be able to contribute to the non-IRA account since it's considered property. So let me just expand on that a little bit. So, but what this person could do, now this person's 79 years old, so it may be challenging for him or her, but if they maybe went back 5 years ago or 10 years ago and started thinking ahead like we'd like to do, we run into this all the time because we have strategies for moving funds from a traditional IRA to a Roth IRA. But then we're stuck with these funds in a taxable account that are forever creating capital gains, interest, dividends, and like this person's situation, it runs into uncontrollable, sometimes capital gains, dividends, and interest. And now you've got this big tax burden. What this person could have done is they could have taken an amount that was appropriate out of their taxable account. And if they qualified for it, shift that money over to a life insurance retirement plan or a cash value life insurance. Those terms are interchangeable. And fund that money into the life insurance. Now that does a few things. First of all, it gives you a life insurance death benefit that is tax-free to your heirs. Oftentimes, there is also a long-term care benefit that is attached to that death benefit, which is a tremendous asset, I believe. And then depending on the type of policy that you structure, cash value can build in that life insurance policy. And when it builds in that policy, it builds tax deferred and it comes out tax-free, either in the form of a death benefit, or don't forget, you don't have to necessarily die to realize the benefit of the life insurance. You can, it could be there as long-term care, or you can, as long as you structure it properly, you can take money out to help fund your retirement. So you can, there are folks who we're working with who are taking $40,000, $50,000, $60,000 a year in distributions from their non-required distributions from their life policies, and all that money is tax-free. So there's a way to head this off. I would have loved to talk to this person, 5 or 10 years ago and help him or her plan for this, but there is a way to handle it. But unfortunately, it's not funded in IRA. So moving on here, the next question. I heard Ed Slott speak a while ago at a webinar on the recent interpretation by the IRS of the 10-year rule, but wanted to make sure that I understood correctly as it pertains to a client of mine. So this is a financial advisor who heard Ed speak about this 10-year rule, and now he or she has questions, and there are always questions about this 10-year rule. Client inherited a traditional IRA from his mother in 2020. She was already taking RMDs when she died in 2020, as she was in her 80s. That's the first thing to pay attention to. So under the new regulations, was the client required to take RMDs already? Check that off. Yes. Then that leads us, it's like a flow chart. It leads us to the next step. My understanding, in fact, I'm sure Ed will come out with a flow chart to show exactly how RMDs need to be taken. My understanding is that our client needs to take an annual RMD since his mother had already started taking them. Yes, that's correct. In addition to the annual RMDs, he needs to make sure the entire IRA is distributed by the end of the 10th year. Is this correct? Annual RMDs in addition to complete distribution within 10 years. Also, assuming he does need to continue with the RMDs each year, which life expectancy table does he use to calculate his annual RMDs each year? These are all great questions. Thank you in advance. And this person's name is Christy. So again, the parent already has begun taking their required minimum distributions, has passed the required beginning date. So that's the first thing to pay attention to. Is it an eligible designated beneficiary? No, because it's a child. So there is that 10-year rule. The new regulation says that in addition to the distribution at 10 years, at the end of 10 years, RMDs must be taken if that person has reached the required beginning date. So this person's right. Then the next, Christy's right here. Then the next question is, which life expectancy table do they use to calculate the RMD? So great question, Christy. So let's see what Sarah says here. All right. So, hi, Christy, your understanding is correct. The IRS really threw us a curveball here. Unexpectedly, the new proposed regulations are requiring annual required minimum distributions during the 10-year payout when the account owner dies after her required beginning date. The RMDs are calculated using the IRS single life expectancy table and are based on the beneficiary's life expectancy. That is the question that would most commonly be the next question. Okay, well, whose life expectancy is it based on? So these are really great questions. And if you, again, the table is available. If you go to my website under Slott Corner and you go into the uniform lifetime table. Oh, you can't download that one, darn it. So the single lifetime table is the one that you need on there. So I'm going to have that repaired so you can download that. But if for some reason you need that table, just send me an email and I'll get it to you. All right, here's the one. This is a little complicated, so stay with me here. We're going to spend a little bit more time today on the slot updates because I think this illustrates some of the difficulty really, really well, as does this question, by the way. Let me just make sure I'm still sharing. Yeah. All right. So, so this is about Joe and Lucy, different rules within the 10-year period. So follow along. I'm going to read this to you, but follow along here. Some of the proposed, this is by Andy Ives, so one of the analysts with the Ed Slott Group. Some of the proposed Secure Act regulations released in February are convoluted and unnecessary. We have made our opinions known. Fortunately, many of the confounding new rules, several of which we have written about, will be limited in their impact. However, a new discovery could affect a larger percentage of IRAs and 401k beneficiaries. The combination of a few basic principles may lead to an inherited IRA confusion. Does order plus order equal chaos? So Joe is age 75. He has a traditional IRA. Joe dies and leaves the IRA to his daughter, Lucy. Lucy does not qualify to stretch payments as an eligible designated beneficiary over her lifetime. So she must apply the 10-year rule. The entire IRA must be emptied by the end of the 10th year after the year of death. Additionally, Joe died after his required beginning date, April 1st of the year after he turned 72. So Lucy must take required minimum distributions in years 1 through 9 of the 10 years. Makes sense so far under the new rules. The above is straightforward. Let me move this up. The above is straightforward, orderly, and recognizes the proper interpretation of the proposed Secure Act regulations. But now we add another common scenario that inadvertently dials up the complexity. Joe also has a 401k. So he was still working, even though he was, older than 72, he was still working. Joe has a 401k and is actively employed until the day he died. Since the 401k plan adopted the still working exception, and Joe did not own more than 5% of the company, his required beginning date, his plan required beginning date, would not have been until April 1st of the year after he separated from service, had he had lived. As such, Joe is not yet taking RMDs from his 401k. Folks, if you're still working and you don't own 5% of the company and the plan says you don't have to, then you don't have to take distributions, required minimum distributions from your 401ks. So that was Joe's situation. He had to take them from his IRAs, but not yet his 401k. So how does it affect his daughter? Daughter Lucy was the beneficiary of the plan. Since Lucy is not an eligible designated beneficiary, she must apply the 10-year rule to the 401k. However, since Joe died before his plan required beginning date, Lucy will not have RMDs through years 1 through 9 with the 10-year period. Now that's interesting because it's not about necessarily about the age, is it? It's about have you crossed the required beginning date. And in the IRA, the answer is yes. In the 401k, the answer is no. So two different rules apply. IRAs, as I said before, IRAs and 401ks and different types of IRAs have different rules. So you have to be careful and pay attention to those rules. Okay, but Lucy, let's go here. But Lucy elects to roll the 401k assets into an inherited IRA. What happens then? Which is a common request. Of course it is. I want to roll this over to an inherited IRA, maybe one I already have established, or set up a separate one. Lucy now has two inherited IRAs from the same decedent. While both inherited IRAs must abide by the same 10-year period, assuming the beneficiary payout guidelines carry over from the plan to the inherited IRA, one of the accounts has annual RMDs in year 1 through 9, and the other does not. So introducing chaos, they say. We know that inherited IRAs from the same decedent can be consolidated. So you can, as I said, we can either roll it into an existing IRA, an inherited IRA, or create a second one. If Lucy elects to combine the inherited accounts, which of the payout rules will take precedent? Does it matter if she transfers inherited at the first IRA to an inherited IRA or vice versa? Does the fact that she has two different payout rules eliminate her ability to consolidate? And who on this planet will be responsible for tracking what assets came from which account and what payout period is to be followed? So therein lies the conundrum. So such a scenario is intriguing because it's not so far-fetched. In fact, it is extremely likely to happen just millions of times throughout the next several years. Many plan participants are currently leveraging the still working exception. There are a lot of older folks still working. A significant, and by the way, with large 401ks. So a lot of the folks still working, are high-level executives and they have large 401ks. So this required minimum distribution, non-required minimum distribution is going to be a big deal potentially. A significant percentage of these same people also have IRAs. I suspect we will see this potentially confusing combination of inherited IRA and inherited 401k payouts more frequently in the years to come. Future guidance would be certainly welcome. So how can you deal with that? One of the easiest ways is you have two inherited IRAs. So you have to be able to track where the rollover came from. So from the IRA, the decedent's IRA to, as they said, IRA X here, and take the 401k right over to IRA Y. That makes the most sense to me. You can invest in the same way if you'd like to, so it doesn't really matter. It's just one's going to have a required minimum distribution and one isn't. All right, I see two questions here. Gerard, let's see. How would a 55-year-old deceased person's IRA that was converted to a beneficiary designated IRA 8 years ago fall into the 10-year rule? RMDs have been taken already, but fall short of depleting the account completely. The beneficiary is now 78 years old. So 8 years ago, they would have fallen under the previous rules. I'm just thinking here. Yeah, and 8 years ago, they would have fallen under the previous rules. So I'm not sure if they would have to be depleted within 10 years. It would fall. Yeah. Send me an email about that, Gerard, and I'll forward it. But my thinking is that it would fall under the previous rules, not the Secure Act rules, and it would not. So therefore, would not have the 10-year requirement. Good question, though. Okay, let me stop my share here. So that is the slot updates. And again, I know that's a lot of information and I find it really interesting and intriguing. Maybe you don't. Let me know your thoughts in the survey. So you get a survey. We've updated it. Thank you, Kathy, for your suggestions. Listen, these required minimum distribution issues and IRA distribution issues are really very, very important. So it's good to know what we're dealing with. All right, one other question here. Doug, what is the status of increasing the age for starting RMDs? Doug, the status is that it's still in legislation. So it passed well through both chambers, I believe, at this point. Certainly the House. I'm not sure what the Senate. I had to check in to see where the Senate is on it, but it's not the rule yet. But good question. And it doesn't happen right away. So I don't remember the schedule, but it's a graduated schedule over time. But ideally, I must end at the webinar. Sorry. Ideally, for me, it would happen immediately. We go right to 75 because I'd be happy to take distributions from IRAs if needed, but not being forced to. Okay, let's move on. Talk about the markets. So. Really great week last week, right? So the Dow Jones Industrial Average was up 6.19%. The NASDAQ was up 6.85%. Even bonds were up just about 1%. And that brings us, let me see, I captured this. So that brings us just down for the month at 0.52 for the Dow Jones Industrial Average. The NASDAQ at negative 2.75, and the bonds up for the month 0.76%. But for the year-to-date numbers, they're still not great. Nasdaq's down 22%. The Dow Jones is down 7%, and the bond markets are still down 8.16%. And year-over-year numbers are still all negative across the board. So we're catching up as of last week a little bit. We're setting back here this week. So who knows where we're going to end? It's just, as you've heard me say, it's just going to be a very, very volatile time over the next, what do we have here? We're coming up on 7 months, a little over 7 months, right? Here's some analyst reports. Not, as I said, we really don't, I have two here to review. And the first was this report from Robert DiLucia from Prudential or Empower. He writes, despite the challenging long-term outlook for inflation, Federal Reserve policy, and long-term interest rates, there's growing probability of a mid-cycle adjustment phase that could spark a rally in both stocks and bonds. So he's optimistic that we could see a continued rally in stocks and bonds. We'll have to see. Again, you've just got to set yourself up where your immediate needs are taken care of, and using asset allocation, principal protection, and account segmentation. And we can handle these shocks, but it should not be affecting you in the short term. And frankly, as you've heard me say, I'm really not as concerned about stock investments, because most of our heavy stock investments lay out 9, 10, 13 plus years. But the bonds are very, very troubling. So now we're seeing some stability in the bond markets, which is good. We sold out of many of our bond positions over the 6 weeks, 8 weeks ago. So I don't anticipate that we'll be buying back in anytime soon. We're going to take other measures to give us those bond-like returns, but with some protections. But I can't go into specifics in this webinar. But at least some folks are feeling optimistic. And this other analyst report was from Riverfront. And it's something I was talking to someone about in the past few days, and that's the housing market. And in fact, I've been talking to a lot of folks about this. And I was reading an article that certain areas in Florida and I think it was Boise, Idaho, are down significantly already. And it may have been the Wall Street Journal, but we're talking about down 30% and 40% in home values. So that's happening very, very quickly in some of the hot areas. But as I think I've said on this webinar, my opinion is that, of course, we're going to see a softening of the housing market. People don't buy houses generally. Most people don't buy houses based on the value of the house, right? So it's really based on the monthly payment. So if a $500,000 house was going to cost you $2,000 a month, and now that same home priced at $5,000 because interest rates are higher. So 6 months ago, it would have cost you $2,000 a month, and now it's going to cost you $2,500 a month. Well, that might be beyond your budget. So the only thing that can happen is, well, there's one of two things. The buyer goes away and the house just sits there valued at what it values. And someone would have to come up to that level to pay for it, or the price has to adjust down and now bring it back down to the $2,000 level. So that makes sense to me. Maybe I'm missing something. Maybe I'm oversimplifying it, but it seems to me that as interest rates go up, the economy continues to struggle. People are paying more dollars for other things, because it's not like, listen, again, I paid over $85 to fill up my Jeep. My friend I was riding bikes with yesterday, he has to use premium gas in his Jeep, and he paid over $90 some. So as people are paying more for everyday things like food and fuel and clothing, and they can't find certain things, there's got to be a balance somewhere. So if you're maxing yourself out on your home purchase, and you're a younger person, let's just say, you should be taking these other things into consideration. What happens if I buy this home and then I can't furnish it, or I can't pay for my gas, I can't pay for tuition? There's a lot of thoughts going around. So I think there has to be some softening in the housing market. In fact, I'll read to you what they say. Housing needs to cool off, and it probably will. Riverfront's current thinking is that the house prices are at or close to a peak, and in markets that have been overly speculative will come down somewhat. However, due to strong supply-demand conditions, we believe most markets are more likely to rust than bust. In this weekly view, Rod Smith provides our outlook on the housing market, so we went on with that. Rod Smith is a really, really great analyst. And if you Google him, so it's Smith, Smyth. but you can look at this, read this report or watch the video for the report. But again, I don't see how, we've got a pretty hot market here where we are. I don't see how prices don't soften, maybe 10, 20%. Okay, so now let's talk about our financial planning topic. I'm going to, I don't see any questions. So today, I was thinking to myself, is this really a planning topic? But we're going to treat it as one because it's obviously important. So I'm going to share my screen here. So let's talk about what is a registered investment advisor. So RIA is the term, it's they're interchangeable, registered investment advisor and RIA. So I'm just going to read you this definition that came from the article. A registered investment advisor is an individual financial advisor or a company that provides its clients with financial advice. Unlike other types of financial advisors, RIAs have a fiduciary duty to act in your best interest. And that's my first bullet point here, fiduciary duty. So this is something that, I've really struggled with my entire career. And when I was at starting at Payne Weber, UBS, Wachovia, Wells Fargo, I never quite understood the conflict with this fiduciary duty. Fiduciary duty simply means putting the best interests of the clients first. So I believe that most financial advisors do that, but not all of them have the duty to do that. So any person who holds the designation of CFP, Certified Financial Planner, has a fiduciary duty. So even if your firm that you work for, Morgan Stanley, Merrill Lynch, whomever, doesn't have that fiduciary duty, and they in many ways they don't. They operate under a suitability standard. So an investment can be suitable for a client, but not in the best interest of the client, which means that the firm or the advisor can profit in a greater way based on their recommendation than on a recommendation that might be in the best interest of the client. So that's unfortunate. And thankfully, the large firms are coming around. They're being forced to come around by regulators, and there is now this regulation best interest that has to be enforced. But they've been fighting it for many, many years. So I never quite understood that. But as registered investment advisors and certified financial planners, we have a fiduciary duty to our clients, and that is, it seems very simple, but it doesn't carry across the entire industry. So I once had a person who came to me after a class, and they were talking about their advisor who was at a firm called Ameriprise. And this is no reflection on Ameriprise, but this fiduciary term has become very important over the last 5, 6, maybe 10 years. Now, one of my designations is a accredited investment fiduciary. So that's specialized training I have in the fiduciary process. And you've heard me say I've taught this to attorneys and the Bar Association here several times. It's very, very important to me. But this woman said, I asked my advisor if he was a fiduciary, and he didn't really answer the question. And I said to her, well, then the answer is no, right? If you can't say yes, the answer is no. And unfortunately, it's very circular. So the answer to that question, when the advisor is not a true fiduciary, and this article from Forbes goes further to, they really spend a lot of time talking about the term advisor and if advisor should be used if there is no fiduciary duty or responsibility to clients. So really, really interesting article. I'm just going to read you one paragraph here. It says, the fiduciary responsibility is important because it ensures that the person managing your money is also making the best choices for you in terms of products and fees. As fiduciaries, IRAs are legally obligated to put your interests above their own and to discuss any potential conflicts of interest. So that's an important part of it too. And all these things have to be documented. And thankfully, the SEC and the state regulators and FINRA, which is another regulatory agency, have become much more aware of this, and the public, which is most important, has become more aware of this. So I'm glad to see that. So an RIA can be a large RIA. So in our process of determining how we were going to, we had an affiliation with a company called Kester, who was a broker dealer who handled our regulatory compliance and our trading platforms and things like that. So when we were looking to do something different, we said, okay, there are companies out there that are large registered investment advisors. Do we affiliate with one of those for economies of scale and things like that? Or do we finally just set up Attleboro Wealth Management as a standalone RIA? So we chose the latter. So we register directly currently with the SEC, and we're in the process of registering with the state regulators that we have to register with. But there are certainly regulators involved. In our case, we also have still an affiliation with FINRA because of some older accounts that we have. So, regulated in every state the RIA does business, and with the federal regulators. I see a question. I'll come back to that. Now, you also hear this term investment advisor representative, IAR, not to be confused with RIA. So what is a IAR? Well, Attleboro Wealth, in our example, Attleboro Wealth Management is the RIA. It's not Mark Byelich. Mark Byelich is actually, and in our case, Emily Wheeler is actually a IAR, an investment advisor representative for the firm, right, under the firm. So I just want you to understand the difference, right? That doesn't mean because we're investment advisor representatives that we don't have the fiduciary duty. We of course do. It's just really a determination from the regulatory authority. I don't believe that an individual, in fact, I know that an individual cannot be an RIA. It has to be a company. Okay. All right, let me check our question here. Doug, what about CRPC designation? Is it equivalent to CFP? No, I don't remember what CRCP or CRPC means. Let me just look it up. There's a ton. This is a great question, Doug, and probably could use its own its own discussion, its own webinar. But let me just pull. I'm just Googling. I'll share with you my Google screen here. So this comes from the American College, or the College for Financial Planning. So the College for Financial Planning and the American College are two training institutes that offer the CFP designation, Certified Financial Planner, but then also offer some of their own designations. So Chartered Retirement Planning Counselor. So there, this is specialized to retirement planning. It's very condensed. Let's just see the time that it takes. I'd have to see, but many of these, unfortunately, take very little time to complete. It's a $1,300 investment, as you can see, and it might take a month to complete something like this. I don't know for the CRPC, but I'm guessing that it does. This is only a, let me see if there's any board. Yeah, my thought is that the CRPC program is really a College for Financial Planning program, or let me just see if there's any. Kaplan offers it. No. Yes. But the CFP, Certified Financial Planner, is really from a planning perspective, the only board certification. There's also Chartered Financial Analyst, which is a board certification, but it in no way is an equivalent to a CFP. But that's a really good question, because you can, if I Googled here financial designations, let's just see. The other things, with the CFP, you have to have a 4-year degree. This one isn't bad. Chartered Financial Consultant. The American College offers this. That's, again, their designation. The Chartered Financial Consultant, that's actually 2 more classes that are required than the CFP. The difference is that it doesn't have a comprehensive exam. So you don't have to show proficiency. With the CFP, you have to pass, I think it's 5 exams. It might be 6 now. You have to present a plan that has to be approved, and you have to pass. When I took it, it was a 2-day, 11-hour exam, comprehensive exam. That 50% of the people who take it don't pass. So it's very significant. So to answer your question, no, the CRPC designation is not equivalent to CFP. But I might, as I said, I might do a webinar just about that. Okay. All right, so that's all I have for today. It's 10:41. We're pretty much at the limit anyway. I wanted to share a little bit about this difference between what is an RIA and what is a typical advisory firm, right? Or a brokerage firm, like the big firms. The Morgan Stanley, Merrill Lynch, Wells Fargo, they have an RIA component also for their advisory business, but they have to walk a very tight line about suitability and best interests and fiduciary. So it's simple. If you're not sure if your advisor is a fiduciary, ask. If he or she can't say anything but yes, they don't have the same requirements that a fiduciary does. So I hope that was helpful. I hope you all have a great week, and I will not see you next week, but I'll see you the following week. So see you in 2 weeks, and take care of yourself. Bye-bye.